fundsupermart.com.
With us today is Francis Ellison, investment specialist at Threadneedle, to give us an update on the European market. Hello, Francis. Thanks for joining us. So, in general, what are the driving forces for Europe in 2013?
Our general view is pretty positive. We think there's a number of factors which will boost markets this year. Firstly, towards the tail end of the year, we'll see a recovery in overall economic growth in Europe, probably particularly focused on the harder currency or the stronger areas of Northern Europe. Secondly, there's a valuation boost because European equities are considerably better value than a lot of other markets worldwide. And the key figure I'd mention there is that you can get a yield of over 3% on European equities, very impressive relative to yields on quality bonds and cash. And finally, we're expecting good profits growth from Europe, again, particularly in the second half of the year.
Which markets or sectors present the best investment opportunities?
Well, we're more bottom-up investors, but we do look at the macroeconomic situation, and we would say that the better opportunities are in the strong defensive growth companies, which typically operate on a global scale. We're finding better opportunities in those exporters, so in industrial and consumer sectors, and in particular, again, in the stronger economies based in Northern Europe. But we're not missing opportunities. There are selected opportunities throughout the continent, and we're very much aware of that.
So, in terms of valuations, are the markets looking attractive at the moment?
Yes, we do. I mentioned that figure of 3.3% in terms of income return you can get from equities. And that's very impressive, not only relative to other markets worldwide, both here in Asia and also in developed markets like the US. But it's also attractive relative to history. It's better than you would have got historically from European equities, and it's better than you will get in terms of returns from cash and from bond markets.
So what's your take on the investment case for small caps?
Smaller companies are attractive. Now, the challenge with smaller companies is that there's already been a strong degree of outperformance in recent years. But the attractions of smaller companies is that they tend to produce better growth over the long term than larger companies. And we see that particularly in the current year. We think that there'll be at least 5% of better earnings growth coming through from smaller companies than from large cap. And in addition to that, the smaller companies within Europe have not been well represented in the problematic sectors, which are the typically domestic sectors, such as financials and telcos and utilities. There are some small cap companies in those areas, but they tend to be more dominated by large cap.
Okay, finally, what are some of the remaining risks in the region going forward?
Well, it's very good timing that, because we've just had a very obvious risky scenario that's come out of the Italian election, where there's no clear result, and there's very large proportions of the poll taken by new organizations, new parties with cynical attitudes towards Europe and so on and so forth. And I would think that's a risk in a number of other countries in Europe. We've got elections coming up in Germany in the autumn. We think that the outcome of those is probably going to be a little bit more comfortable and predictable than what's happened in Italy. But certainly the political situation is uncomfortable, and that does have impacts on markets generally, because it impacts government bond yields and the costs of the raising money, and there's been a considerable correlation between those government bond yields and equity markets. So the political socio-economic risk is still very much there. It's there in the short term, it's there in the long term as well, because Southern Europe is going to struggle in terms of economic growth for a long time, and that will mean that equity markets won't go up in a straight line. It'll be a bumpy path, but we do think we're going to achieve positive returns.